Welcome to the Learning Square. You may have come across the term futures a lot of times with respect to investment. In today's video, we will be seeing what are futures, how a future contract works, how is this different from the traditional stock trading, and some key facts which you should know about stock futures. So let us begin. Futures are nothing but investment made against a changing value. A futures contract is a legal agreement which gives the investor the right to buy or sell an asset at a predetermined price at a specified time in the future. So, on the specified date and future, the party has the obligation to buy or sell at the predetermined price, irrespective of the current market price. Historically, futures have dealt in commodities, such as crude oil, gold, or other tangible goods. Modern futures contracts cover virtually any tradable asset, including stocks, currency, bonds, and even cryptocurrencies. Let us see an example, which will help you get a better idea on how a future contract works. Imagine a popcorn shop owner, Alex, selling popcorn. Alex sells popcorn throughout the year. To make popcorn, he needs corn from the farmer. The price of the corn varies daily based on the supply and demand, but he has to sell popcorn at a fixed price. Let us consider, Alex buys corn from the farmer for $3 per bushel today, and makes some profit selling popcorn. Season changes, and it's harvest time. The supply of corn is more, and the demand is less. The corn price falls to $2. Alex can now get the popcorn for a lesser price, and he makes more profit now, selling the popcorn. Season changes again, and this time there is high demand for corn, and the corn price jump up to $4. Alex now has to pay more to get the corn, and his profit, selling popcorn, reduces. So, when the corn price is less, Alex makes more profit, and when the corn price is high, he makes less profit. If the corn price is changing frequently, his profit will also change frequently. So, to avoid this variable profits, Alex enters into an agreement with the farmer to buy the corns at an agreed upon price, say $3, on 1st of every month, for a year. So, as per this contract, on the specified future date, which is 1st of every month, Alex has to buy corns from the farmer for a fixed price, which is $3 here. So this futures contract will help Alex as below. 1. When the current price of corn rises to say $4, Alex can still buy the corn at $3 per the contract. 2. When the current price of corn falls to say $2, Alex still has to buy it at $3 per the contract, but Alex is still happy, as he has already planned and prepared for spending this amount to get the corn, and is not affected by drastic market fluctuations. Now, let us just correlate this with the definition of futures contract we saw. As per the futures contract, the investor has to buy, in our example, Alex has to buy, at a predetermined price, $3 here, which is already predetermined and fixed, at a specified time in future, which is the 1st of every month. So, we believe you now have a fair idea of what a futures contract is and how it works. Let us now see an example of stock futures and compare it with the traditional stock trading. Our friend, Alex, has now become an investor. Good job, Alex. Alex buys 100 shares of company ABC for $20. Let us first see how a traditional stock trading works. Alex is planning to sell his shares for $22 and approaches a broker, who in turn gets in touch with Anna, who is willing to buy shares of ABC for $22. In this example, Alex is selling his shares because he believes that the share price will go down and he is fine to lock up profits. And Anna is buying it because she believes that the share price will go further up. This is how a stock trading works. For more details on stock market, please check out the video shown in the above link. Now, let us see a similar scenario with the stock futures trading. Per the definition, the investor enters into an agreement through which he has to buy or sell the asset at a predetermined price on a specified date in future. In our case, Alex enters into a futures contract that he will sell shares of ABC for $20 after 3 months, and Anna enters into a futures contract that she will buy shares of ABC for $20 after 3 months. There can be many reasons on why Alex is selling it for $20. One reason can be that he is not getting buyers now to sell at a higher price, and he sees the share price of the company going further down. So, he decides to sell it for $20, which would prevent him from huge loss. Anna is buying it for $20 after 3 months because she believes that the share price after 3 months will be higher and she would profit buying it much cheaper. So, this is how a futures trading works. Now, let us see some investment terms involved in this transaction. Buying the shares is referred to as taking a long position. Selling the shares is referred to as taking a short position. The price which has been agreed upon to buy or sell the share is referred to as the strike price. The date on which the future contract will take place is referred to as the expiration date. Value of future contract refers to the difference between the trading price and the strike price. Let us see some key facts about stock futures. Number 1. The contract size of a stock future is usually 100. This means if you are entering into a futures contract, it will involve minimum 100 shares in a contract. It also means that one has more exposure to the stocks in a futures contract, as compared to traditional stock trading, where you can even buy one share. Number 2. The interesting and important part about buying or selling futures contracts is that you only pay for a percentage of the price of the contract. This is called buying on margin. A typical margin can be anywhere from 5 to 20% of the price of the contract. For example, if a crude oil futures contract is quoted at $10,000, a futures account holder can enter a long position, that is, enter into an agreement to buy the crude oil futures by posting only $500 initial margin, or 5% of the contract value. In other words, even if you have just $500, you can buy a $10,000 crude oil futures contract. Number 3. On purchasing a futures contract, the owner does not become a shareholder. Owning a futures contract does not entitle the person to any shareholder benefits, like dividends, bonus, or any other rights. Number 4. Since stock futures have more exposure, it involves higher risk. Number 5. You cannot hold a futures contract for a lifetime, as you can do with a stock purchase. We have seen how a stock futures work and how stock futures trading differs from the traditional stock trading. Let us now compare the traditional stocks with the stock futures from an investment perspective. Consider, Nancy has $1,250 to invest and is interested to purchase shares of company ABC, which is currently trading at $125. Option 1, let us assume she wants to invest in the traditional stocks. So, she gets 10 shares of company ABC, and invests her full amount of $1,250. Now if the share price of company ABC goes up to $135, she earns a $100 profit. Option 2, now, let us assume she plans to invest in the stock futures, and enters into a long position, by paying the margin amount, which is 10% here. Since the margin is 10%, she pays only $1,250 to enter into this agreement. Now, if the share price of company ABC goes to $135, she earns 10 times 100 equals $1,000 profit. As you can see, with the same amount, and investing in the same company, the profit varies, based on how the person has invested. By just paying $1,250 initially, Nancy was able to get $1,000 profit, investing in stock futures. It is also important to note that just as futures can help getting better returns, it also carries higher risk of loss. To summarize it, stock futures is more suitable for traders who are trying to get profits and are ready to take up higher risk. The traditional stock method of trading suits the long-term investors better, as it has lesser risk compared to the futures. And we will stop here today. There's still more to discuss on futures and how to trade futures, which we will cover in our upcoming videos. Hope this video was useful to you, and you got some idea on how a stock futures work. Please do like and share your thoughts in the comment section below. Please support us by subscribing to our channel and sharing it with your friends. Until next time, goodbye and thank you so much for watching.